Imagine waking up to see $1.3 trillion in stock market value wiped out in a single market cycle. It wasn't a banking collapse, a housing crisis, or a global pandemic. It was a sudden, violent realization that the entire global economy is resting on a razor-thin layer of silicon. On Wall Street, the Philadelphia Semiconductor Index suffered its deepest single-day plunge since March 2020, erasing hundreds of billions in market capitalization from giants like Nvidia, Micron, AMD, and Broadcom. Trillion-dollar tech titans saw their valuations shaved by hundreds of billions in mere hours as investors suddenly confronted the terrifying reality of the semiconductor bottleneck. But here is the paradox. This colossal market shock didn't happen because the chip industry is dying. It happened precisely because the industry is exploding at a rate human supply chains simply cannot keep up with. Right now, in 2026, the global semiconductor market is officially breaching the historic $1 trillion to $1.3 trillion annual revenue milestone, years ahead of original forecasts. Yet behind that jaw-dropping headline number lies one of the most dangerous economic imbalances in modern history. We are living through a massive structural split, where high-flying artificial intelligence accelerators are capturing nearly half of all silicon revenue, while consuming less than 0.2% of total physical chip production. Meanwhile, the remaining 99.8% of the world's chips, the ones that power your car, your smartphone, medical devices, and power grids, are getting squeezed by hyperinflated component costs and fragile geopolitical supply bottlenecks. This is not just a tech story. It is a battle for global economic dominance, financial survival, and the fundamental architecture of the future. To understand where the money is flowing and where it is vanishing, you have to look at the numbers driving 2026. Global semiconductor revenues have shattered all previous records, driven almost single-handedly by hyperscaler capital expenditure. Tech giants are pouring over $600 billion this year alone into building out massive AI data centers filled with cutting-edge GPUs and high-bandwidth memory. Generative AI hardware alone is accounting for nearly $500 billion in annual chip revenue. But here is the vulnerability that triggered Wall Street's $1.3 trillion panic attack: extreme market concentration. Out of more than 1 trillion individual semiconductor units manufactured globally this year, only about 20 million are ultra-advanced AI accelerators. That means half of the world's semiconductor money is concentrated in a tiny fraction of total physical volume. This concentration has created a stark divergence in pricing dynamics across the industry. Yesterday's pricing model for silicon was based on steady, predictable node shrinks and incremental cost reductions. Today, we are witnessing a phenomenon known as Memflation, a brutal surge in memory pricing where DRAM costs have skyrocketed by over 125%, and NAND flash prices have surged by more than 234% in 2026. Because AI servers consume vast quantities of high-bandwidth memory, HBM3E and HBM4, memory manufacturers have shifted production capacity away from consumer electronics toward high-margin enterprise memory. The result? Prices for standard components are spiking, crushing profit margins for automakers, consumer device makers, and industrial manufacturers who simply cannot compete with the purchasing power of AI hyperscalers. Why can't semiconductor foundries just build more chips to meet this insane demand? The answer lies in the physics and astronomical economics of modern chip fabrication. A state-of-the-art semiconductor fabrication plant, or fab, is now the single most expensive and complex facility built by human hands. Building a single leading-edge 2-nanometer or 3-nanometer fab today costs between $20 billion and $40 billion. Inside these clean rooms, which must be up to 10,000 times cleaner than a surgical operating room, sits the most advanced machinery ever engineered: extreme ultraviolet EUV lithography systems manufactured exclusively by ASML in the Netherlands. Each EUV machine costs upwards of $200 million to $350 million, weighs over 180 tons, and requires 3 cargo planes just to ship. This high barrier to entry has led to unprecedented consolidation. Over 90% of the world's most advanced logical microprocessors are manufactured by a single company on a single island, TSMC in Taiwan. This single point dependency represents a $1 trillion geopolitical fault line. To de-risk this fragile node, the United States executed the CHIPS and Science Act, funneling tens of billions of dollars in subsidies to build out domestic megafabs in Arizona, Ohio, and Texas. However, physical reality has proven far harder than passing legislation. American fab projects have faced severe headwinds, including chronic shortages of specialized cleanroom engineers, complex supply chain delays for ultra-pure chemicals, and massive capital expenditure overruns. While these U.S. foundries are finally coming online in 2026, scaling yield rates to match Taiwan's efficiency remains a multi-year uphill battle. To fully grasp what changed between yesterday's chip industry and today's landscape, look at how profit pools have shifted. Yesterday, during the traditional smartphone and PC era, the chip market moved in predictable 4-year boom and bust cycles driven by consumer upgrades. Today, AI infrastructure spending has completely decoupled chip demand from traditional consumer economic cycles. In 2026, consumer smartphone chip revenues have stagnated around $89 billion, and Internet of Things, IoT, chip spending faces inventory digestion issues. Yet total semiconductor industry revenue is reaching $1.3 trillion, purely on the back of enterprise compute and data center architecture. This dynamic has created massive winners and devastating losers in corporate earnings. Companies that secured early design wins in custom silicon, high-speed networking switches, and advanced packaging technologies are posting record profit margins exceeding 60%. On the flip side, chipmakers tied strictly to mature legacy nodes or non-AI consumer markets are seeing their margins compressed by surging raw material costs, higher wafer prices from foundries, and lower unit volumes. Furthermore, the industry is grappling with new physical bottlenecks, power and packaging. It is no longer just about printing smaller transistors. It is about supplying megawatts of electrical grid power to data center racks and assembling multi-die chiplets using advanced 3D packaging. Without advanced packaging capacity, even the most expensive silicon wafers sit useless on warehouse shelves. As we look toward the remainder of 2026 and beyond, the semiconductor industry sits at an unprecedented inflection point. On one hand, reaching the $1 trillion annual sales milestone solidifies silicon as the fundamental oil of the 21st century digital economy. Every breakthrough in artificial intelligence, autonomous transportation, quantum computing, and national defense relies entirely on this microscopic layer of patterned sand. On the other hand, the $1.3 trillion market valuation volatility proves that Wall Street is waking up to the systemic risks of a high-margin, ultra-concentrated supply chain. The companies that win the next decade won't just be the ones designing the fastest neural processing units. They will be the ones that master supply chain resilience, secure long-term power generation, and navigate the delicate geopolitical tightrope between Western manufacturing and East Asian foundry dominance. The trillion-dollar chip race is no longer just a business sector. It is the battleground where the future of global power and wealth is being written in real time.